we need to do. And hopefully today I'll be able to share some good information with you over the internet on the coronavirus impact on the housing market. This is a challenging time, as I mentioned. So it's better to understand, what's going on to the economy as well as the housing market under the circumstances. And I'll also give you some guidance or some information about what we can expect in the upcoming months. So let's start off. I have about half an hour, right? So in this half an hour, I'll try to cover as much as possible. I'm going to go over some of the impact, like I said, on the economy, on the housing market, and we also have a survey result that I believe some of you probably have received. We sent out a weekly survey every single week for the last 3-4 weeks, and we got some results regarding the transactions, how people are handling the coronavirus situation, and we also are changing things up a little bit every week to try to get the latest information. So I'm going to share some of those results with you in the next 10-15 minutes or so after we talk about the economy, market. And then in the second half of the presentation, I'll attempt to, under this uncertainty, I'll attempt to give you some idea about what we can expect in the when this is all said and done, or first, well, how long this is going to be, and when this all said and done, maybe when we are back to a little bit more normal, how the economy is going to look like, how the market is going to look like, and if time permits, I would talk a little bit about foreign buyers and international buyers, and how the coronavirus situation and the impact might affect those foreign buyers in buying in California. So are you guys ready? Let's get started. Well, let me start with the economic impact. Now, the spread, the outbreak really started, the coronavirus outbreak really started in China at the end of last year, in December. Now, for the U.S., we may not have a lot of impact back then, but things actually started trickling in. You probably remember about a few weeks ago, at the end of February or so, we had the U.S. government had a travel ban restriction. And the travel industry, including hotel businesses as well as the commercial flights, they got affected at the very onset of it. They have already been affected. Take a look at the hotel occupancy rates. If you take a look at the occupancy rate, take a look at this orange line. This orange line is the 2020 number, and the numbers in the background shows a comparable in 2017 to 2019 average. Now, of course, if we are following a similar trend, that orange line should follow the blue line very well into March and into April. But take a look at what happened in the end of February, right around here or so. That's when the WHO announced, the pandemic, the coronavirus as a pandemic. Since then, things changed. Things changed quite a bit. Look at what happened in the hotel occupancy rate. It dropped off quite significantly. It was about 65% or so. It dropped down to 50. Now, the reason why I want to show you all this is I want to show you how the economy has been affected in different areas and different industries. And together, when you put things into aggregate, it actually leads to a significant result to the economy and to the labor market. Now, going back to the travel industry, number of flights, number of daily flights in March also dropped quite significantly. This red line here is 2020. The orange and the purple and the green line, those are previous years. Now, it should be trending along this range, if we're following a similar trend. If the economy is doing well, we should be following this same trend. But as I mentioned, around 11th or so, WHO announced, COVID-19 as an outbreak, as a pandemic. Things started going down even more significantly. It seemed like a long time ago, but it's only about 2 weeks ago that we started seeing some significant decline in commercial flights, the number of daily commercial flights. Now, if you don't travel that much, You may not see a lot of these trends going on, but there are other domestic trends that you probably notice. Probably some of you are moviegoers. You might have gone to see a movie 2 months ago, but a couple weeks ago, that started slowing down a little bit. We started seeing people not going to movie theaters because of the shelter-in-place order and stay-at-home order. Well, not only just because of those orders, people stop going to movie theaters because that's where the crowd is. If you take a look at, again, the orange line, look what happened around the 10th week of the year, which is right around the mid-March. The box office start tanking. Based on estimates from Box Office Mojo and some other, and JP Morgan, it looks like for the next few weeks or so, we probably will see the box office going down to zero, for the US. What about Broadway theaters? We know that New York is the epicenter, and we know that a lot of Broadway theaters closed down because New York has been the pandemic epicenter. So box office receipts went down in the last week or 2 weeks or so, and it's expected to be down for quite some time. And of course, many of you are basketball fans, right? Couple weeks ago, 3 weeks ago, the one of the basketball player in Utah was tested positive, and since after that, NBA shut down their basketball games, and a lot of games actually, as of now, quote unquote, postponed. But we don't know whether the season is going to go back on. They don't. So attendance, obviously, for NBA basketball games went straight down since the beginning of March. Possibly we could have the season back in a month or so. I think I've heard rumor about them picking a specific location where all the teams gather, maybe in Vegas or something like that, and then just have a shorter regular season and then go on to a playoff season. Who knows if that's going to happen? But that affects a lot of people. A lot of TV businesses and things like that. And of course, something that we do on a very regular basis. We used to go out to restaurants and order food and hang out with friends and do dinings. In the last 2 weeks, that plummeted. Based on OpenTable.com, the seated restaurant diners tracked by OpenTable.com again tumbled. The restaurant bookings tumbled since March 10th all the way down in the latest week to by 100%. So what does that all mean? When you look at all these different industries, when all these industries, a lot of people work in this industries actually stopped working, got laid off, and a lot of people cannot really go to work, unemployment goes up. Now, in the first week or second week of March, we started seeing some inched up in unemployment. In the second week, we actually saw unemployment shot up by about from 210,000. This is a U.S. National level. From 210,000 people file claims on a weekly basis to 280 in the second week. The third week went all the way up to 3.3 million. Now, that's a very, very significant number. If you take a look at the graph here, go back to 1970, we've never had a number that high. The last recession we had maybe about at one point at around 700,000. So you can see how significant this is. The unemployment number could climb again this week. I think at some point, one of the economists that I've subscribed to mentioned that there could be at one point go all the way up to 15 million. That's a very significant number. Now, granted, the number could be temporary, but temporary could be for the next couple weeks, next month or so until things get back to normal. And that could cause the economy to go down the drain. And I'll tell you a little bit more about what happened, with the economy in the next, in about 10 minutes or so. In the meantime, when unemployment goes down, we also started witnessing the stock markets, the financial market start getting a little volatile. In fact, the stock market or financial market is sort of a leading indicator. It actually peaked in around mid of February, stayed flat a little bit, and then around end of February, it started tumbling down. From the peak as of last week, I believe, beginning of last week, Dow Jones index actually dropped last week to the bottom to about 33%. That's very significant. That's 1/3 of the index value before it bounced back in the last few days to about 21,000. That's still a decline of 22%. Of course, this is not just a U.S. phenomenon. It's a worldwide phenomenon. This is a global pandemic. We're seeing this, the pandemic, coronavirus pandemic situation, not only in the U.S., but also in some other countries as well. In Italy, for example, in other European countries. So the stock market or financial markets in other countries also tumbled as well, pretty significantly. All those have an impact on the economy. Some of you probably have heard of the wealth effect. Financial market tanking probably affect a lot of people and affect home buyers and home sellers as well. So let's get into the housing market and let's see how it affects the housing market. You can probably see on the right side of the screen, this is a slide that shows showing activity. For many of you who are used to doing open houses and doing private showings, you might be accustomed to seeing what this chart. The showing activity is showing you, how many activities, how many private showings, how many open houses that we have on a daily basis. This is an average over the first 3 months of the year. Now, the blue line here is the 2019 weekly average, and the orange line here is the 2020 average. You can see from here that the average started tumbling down in the last couple of weeks or so, simply because of the shelter in place and the stay-at-home order. People are staying at home, trying to control the spread of the coronavirus, which is the right thing to do. This is what we need to do in order to actually get this under control before we can get back to normal. But it does have an impact on supply and demand. Let's talk about demand first. I was able to gather some information from Multiple Listing Service, from MLS, on the daily average close sales for the first 3 weeks. So this dark blue bar here is the daily daily close sales for the first week of March, which is from 1st to the 7th, and then from the 8th to the 15th, and then 8th to the 14th, and then 15th to 20th. Well, I was not able to get the last day, 21st, for this chart, but I was able to do a decent average. So take a look at what happened. Now, I'm comparing different regions: Bay Area, Southern California, Central Coast, and Central Valley. You can see for all these regions, let me go to the next slide. All these regions, we have dipped in sales, in closed sales. Bay Area dropped about 25%, except for Central Coast. Central Coast continued to inch up slightly by 3.6%. Now, I'm sure when we get this week's number, or last week's number, it's probably going to change a little bit. Central Coast probably will show some decline as well. Take a look at those counties which received the shelter-in-place order versus the county without shelter-in-place. Now, they seem to be, as far as closed sales are concerned, they actually behave about the same. I'll show you pending, and then I'll show you new listings later on. They look a little different. But as far as closed sales are concerned, they actually both regions dropped by about 20-some%, which is pretty significant. Keep in mind, March is usually late March is usually the kickoff of a home buying season, going into April, May, and June, and so on and so forth. Usually, we started seeing some closed sales, some new listings, and some pending sales. Now, if you look at it by individual county, San Francisco got hit quite a bit, dropped by 43-44%. We have Contra Costa dropping 30, Alameda dropping 25% or so. So individual county, we are seeing some drop off. What about pending? Pending usually indicates sort of future closing. Some of the future demand. I shouldn't say future demand, but demand that we have now, but will be closing in a month or so. The pending sales also dropped in Bay Area, in SoCal, Central Coast, and in Central Valley as well. So let's take a look. It also dropped by double digit for most region except for Central Valley, but it's very close to double digit. And again, I use the shelter-in-place order, the counties with the shelter-in-place order versus those without. You can see that there is a difference, at least in that third week. The counties with the shelter-in-place order dropped about 21% as compared to those without. Those without include Napa, Solano, and Sonoma. Dropped 3.6%. And for individual counties, again, we are seeing significant drop and double-digit drop in many counties, except maybe just a few. Like Napa is one that may not have dropped that much, but all the other counties are showing double-digit decline. And this probably would show a continued drop in the upcoming weeks or so. And on the supply side, we look at new listings. If you look at new listings, sellers also have concerns, and so there are not listings. Take a look at the Bay Area. It dropped from 190 daily average to 170 and then to 106. Southern California also dropped pretty significantly. Same for Central Coast and for Central Valley. In terms of percentage, here's the big drop. We got close to 40% in terms of new listings for the Bay Area. Central Coast also dropped 26. Southern California dropped about 18. And then for Central Valley, close to 10%. Again, comparing shelter-in-place to the counties without shelter-in-place, there is a difference. And individual counties, San Francisco actually dropped about 66, 67%, which is the biggest. The other counties, many of those actually dropped more than 40%. Now, I show you the numbers. I show you some MLS data using sales listings as well as pending sales. I want to show you something different, something based on our survey results. This is the weekly survey results that I mentioned earlier that look at maybe a little bit more on why buyers and sellers may not be posting or putting things online, and looking at the realtors at more an individual level. So we send out a survey on a weekly basis, usually around Friday, and collect all the survey results by about Monday or so. And we asked them, some of you may have already received this survey, and for those who actually participated, thank you very much for your help. It really gives us an idea. So let's take a look. We also did this for 3 weeks in a row, actually 4 weeks. We got the latest results this morning. I was not able to incorporate those numbers in here, but I could definitely share some of those results with you if you're interested. But take a look. We asked whether people feel that the coronavirus has or will have a negative impact on their personal real estate business. The very first week, which is the first week of March, only 53% said yes. It jumped to 96%. Obviously, the businesses have been negatively impacted because of the coronavirus. Individual item, we asked them, which part of transaction, which element, in real estate are they most negatively impacted, including open house traffic, sales, and so on and so forth. The latest survey results suggest that a lot of people believe that they have been negatively affected. For open house traffic, obviously, there's no more open houses. Sales dropped pretty significantly, as you saw earlier. Time on market, it's taking a little bit longer to close a deal because of all the slowdown in the transaction process. Time in escrow, closing, supply, which is new listings that I showed earlier. price and market competition. Market competition, as of last week or the third week, 50% actually said it has negative impact, but that number since has jumped to something like 60% or so. And open houses, 60% of the members who responded said, open houses got canceled. About 1/3 of them said they're trying to do more virtual tours. That's one way to do it. 37%, jumped from a 25%. What about their clients? Are their clients kind of holding back from buying? Some of them are. In fact, a lot of them are. In the latest week, 81% said their clients started holding back, as compared to 54%. Buyers who withdraw from their offer. I know some, based on some of our verbatim answers, which I don't have all those answers being shared here, said their buyers are actually withdrawing from an offer because of a lot of different reasons. Because of concerns about the current economic conditions, concern about their financial stability, and also a lot of people are concerned about what happened with the financial market, because the financial market, as you saw earlier, the stock market kind of slide a little bit, had a free fall by 33% at one point. A lot of people lost their down payment. Those who wanted to get their gain from the stock market as down payment, might be gone. And sellers also are holding back. About 2/3 of them, 67% of the sellers are holding back. And we ask whether sellers actually remove their home from MLS or from the market because of coronavirus. 31% said yes, as compared to only 13% said yes in the very first or second week of the survey result. And transactions. We know we kind of speculated that we probably had some transaction that fell through. In fact, about 21%. And the reason why is because buyer backed out. A lot of buyers backed out because of the current economic conditions, 79%. So I just gave you some kind of idea about what's going on with the economy, what's going on with the market. So let's take a look at what we can expect, in the next few weeks or upcoming months. We know things are, like I said, very challenging right now. In the next couple of weeks or so, we probably will continue. Next few weeks or so, we probably will continue to see new listings and sales go down. We want to get an idea of, when things are going to be over. It's really hard because this is very new to many economists. I'll tell you, a lot of economists actually have already changed their forecast quite a few times, because this is not like in 2008 when we had a recession, and we know what actually happened with the recessions, what actually caused the recessions. Back then it was over leveraging. This time it was about coronavirus, and we don't know exactly how long the coronavirus pandemic will last. This is more of a medical health issues that we may not necessarily know, but there are some models out there. There are some models that predict how long a pandemic will last. And based on some of the newest models that I've seen, this is how the impact is going to play out. Looks like, this is for California specific. It looks like the peak is going to be the peak of the impact climax is going to peak at around beginning of May or so. It's going to start, number of cases will probably start going down a little bit. And it looks like by early June or so, we probably will have we could possibly, early June or mid-June, we probably will be back to a little bit more normal. But we have a few more weeks, at least, maybe even a couple months. So this gives you an idea now. This is just one model. There are probably a lot of models out there, but this gives you a sense of how long this is going to take. Economists also look at this. A lot of time they're debating on whether they should look at this as a normal recession or a a disaster that caused a recession, but it's going to go back to normal a little bit faster. Now, if we were to look at it as not a normal recession, but as a disaster, a natural disaster that caused the market to fluctuate and the job market to fluctuate, things will actually go back to normal a little bit sooner. So if you take a look at the slide, this is the jobless claims in Louisiana. We look at the unemployment claims in Louisiana after Katrina hit in 2005. That's a natural disaster. So right after Katrina, we saw unemployment initial claim spiked up significantly, just like what we had in the last week or so. Jobless claims spiked up. It's going to take a few weeks for it to come down, but it came down a little faster than normal recession. So if this is a one-time shock, we could see the job market come down a little bit sooner. Now, at least the next few weeks, we probably will continue to see some fluctuation in jobless claim, some high jobless claims because of all those closures of all those restaurants and movie theaters. But this gives you an idea of what could happen. And some other models, some other examples that we can use from the past is look at some of the other outbreaks that we have seen in the past. SARS outbreaks in 2003. Many of you are somewhat familiar. It never really hit the U.S., but it hit China and Hong Kong quite severely in 2003. The Fukushima disaster in Japan in 2011, and the MERS outbreak in South Korea. This three charts, shows you what happens to retail sales after those outbreaks, after those disasters. And the reason why I want to show you the retail sales is because consumer spending, which makes up a big part of the economic growth rate, is a reflection, retail sales reflect what consumer spending is doing. And it will, if consumer spending or retail sales start dipping down and then spiking back up, it will affect consumer spending and it will affect economic growth rate. So let's take a look at what happened with the SARS outbreak in 2003. It took about 2 months for the outbreak to spread and it hit retail sales to the bottom. So from March to May, it dropped all the way to bottom, and it took about 3 months for things to get back to a little bit more normal. Now, if we have 2-month outbreak of the coronavirus, it could suggest that we could have a 3-month or a little bit longer period of time to recover. For the Fukushima disaster, it took about a month, 2 months, and then it took about 3 months to come back, for the market to come back to recover. The MERS outbreak in South Korea took about 3 months, from May to August 2015, for the outbreaks to spread and hit the bottom, and then it started recovering, and it took about 4 months or so. The coronavirus outbreak the pandemic could possibly take a little bit longer, and the recovery could take a little longer based on the magnitude that we are experiencing right now. And as such, it is understandable that we will need stimulus injections from the government, and the government did put in with monetary stimulus as well as a fiscal stimulus. These are some of the things that the federal government has been doing to help hopefully ease the decline in economic growth. And the Federal Reserve, for example, cut Fed funds rate down to the range of 0 to 0.25%. Many of you probably already noticed, some of the effects that we have had on mortgage rates. Now, mortgage rates actually started declining even before the Federal Reserve started cutting the rates. And in fact, after they cut the rates, some of you probably noticed the 30-year fixed rate actually spiked. In the long run, though, I think the rates probably will go down. I think the reason why we're seeing, spike in mortgage rates a couple weeks ago, or even a week ago, is partly because of the capacity. lenders' capacity to take in all the applications. But that's, a side note. But we also have Federal Reserve also lowered their discount window rates 2.25. They also expanded the reverse repo operations, basically to add more liquidity to the banking system. They also restarted the QE, quantitative easing. And there are a lot of programs that new programs that they created to help preserve the market liquidity. That's the monetary stimulus. On the fiscal side, you probably already know about the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. There are a lot of provisions. There are a lot of detail. We have a lot of detail on fiscal stimulus. I'm not going to go through all of them. I can't even remember all of them. These are some of the provisions that actually may be applicable to realtors, to real estate agents. And I want to just point them out. They have the forgivable small business administration loan. These are loans for, now if independent contractors who take out SBA loans between February 15th and June 30th to use for payroll costs, mortgage interest, and utility costs, it may be something that could be forgiven. We also have the pandemic unemployment assistance.
Oscar, I'm so sorry
Yes.
about that. Time out one moment, please. I just
Sure.
want to let all of our viewers know right now. Everybody who's watching right now, this might be important information that might either benefit yourself or could possibly benefit your clients. So I highly encourage you that while this screen is up right now, you either take a screenshot of it or take a picture of it, so that way you can save this information. It's the only time that you're going to be able to see this information here. And if you need further information on this, please reach out to either myself or Lyman, and we can cascade that information to you. But Oscar, yeah, if you can go back into this, this is really helpful stuff.
Sure. Thank you, Adrian, for pointing it out. Yeah, this is very important stuff. And there's also another slide that I will show that will give you some additional information on where you might be able to get some additional information. And there's also a hotline that I will refer to later on that you can take a look at. And I'll make sure that, I will stay on that slide a little longer so that you can capture all the information. So the second point is the pandemic unemployment assistance. Now, I believe currently they're still working, the government is still working on that particular program. So that program may not necessarily be available right away. The timeline, I'm not exactly sure when they will have available. I would strongly encourage paying attention to the pandemic unemployment assistance for people for independent contractor, for example, who may not be able to apply for unemployment insurance. This PUA program is definitely something that you want to take a look at because it allows provides unemployment assistance for up to 39 weeks. If independent contractors or realtors were negatively impacted as far as their income is concerned as a result of COVID-19. And of course, the very last bullet point, I think that is the point that a lot of people are more familiar with, that is the rebate check that not just realtors, but many people receive if you are under a certain income threshold. If you're under 75,000, you'll receive in general like a rebate check of 1,200. If you're single and if you're a married couple, it's 2,400, and then there is also the additional 500 that may be given per child in the households. So definitely take a look at it. And we do have more information on the CRL website. Let me see if the next slide actually says something. Give me 1 second. Oh, maybe not this slide, but at the very end, I have another slide that will give you some additional information. So I'll point that out, when we get there. So with all those stimulus program, both monetary and fiscal, hopefully it will get the economy back to a little bit more normal, but probably not in the first half of the year. If you take a look at the different forecasts by different economists, by different investment banks, by Bank of America, by Goldman Sachs, by Morgan Stanley, you notice this chart shows you the economic growth rate, the GDP economic growth rate for each individual quarter, and then for the whole year. Now, previously, our forecast, CAR forecast, was to have the 2020 to have an economic growth rate of 1.6%. Obviously, that's not going to happen. But if you take a look at individual quarter, just to give you an idea of what the economic growth rate is typically considered good. When you have a 2%, 3% growth rate, that's usually somewhat okay. 4% would be greater, of course, would be better. But take a look at what happened. In the first quarter, we already affected. Many economists and forecasts still predict that we have a positive, but Goldman Sachs, JP Morgan, Morgan Stanley have already predicted that it's going to be a decline in the first quarter. Second quarter is the quarter that we considered a recessionary quarter, and third quarter as well. Take a look at the individual forecast. Each and every one of them predict a very significant decline. In fact, if you take a look at Morgan Stanley, it predicted a 30.1% decline. Never heard of. There is one more that is not on here. If you take a look at, if you're interested, go to the St. Louis Fed. The Federal Reserve Bank of St. Louis actually predicted a drop-off of economic growth rate by 50%. That's a significant quarter that we're seeing that's a quarter that we're going to see significant decline. Third quarter, some predicted that we're going to see some improvement. UCLA and Wells Fargo both believe that we are still going to see some decline before we climb back in the fourth quarter. Fourth quarter, everyone predicts that it's going to be better. And I do believe that the second half of the year will be a little bit better, but I tend to believe the fourth quarter probably is the quarter that we will see some increase. So in general, if you look at the 2020 for the year as a whole, some economists believe that it's going to be quite significant as far as the drop is concerned. Look at Goldman Sachs, dropped by 6.2%, but generally by about 2% or 3% or so. And as far as the housing market forecast, we have, I'm going to cross that out because that's what we predicted before. 2020, that was what we predicted before the coronavirus, COVID-19. I'm going to cross that out because that is no longer the case. We don't have a specific number right now. We do believe that there will be some changes to home sales. How much change? Let's see. I can kind of give you an idea, but let's take a look at the next couple of slides or so before we jump into some sort of speculation. Let's take a look at what happened in the previous recessions. In previous recessions, what happened to home sales? What happened to price? The gray area is where we have recessions. Now, going back to 1971, we have a few recessions. In 1972, 1973, 1974, we have a mild recessions, and more recently, 2008, 2009, 2010, we had a longer recession. Now, in each and every single recession, we do have a decline in home sales in the very first year at least. Here around 5 or 6 or around 20% or so. Here also about 26% or so. This one is brief. This one is the dot-com bubble. We had a brief decline. The recessions only lasted for about a year or so. So in this one dropped maybe about 5% or so. I can't remember the exact number. Now the last time we had a recession, it dropped quite significantly by about 30%. But then the year after that, it shot back up significantly because housing affordability actually went back. Housing affordability, housing were more affordable, and then we shot back up. What about price? Price-wise, price growth in each and every single recessions, we seem to have okay price growth except for the very last time. The very last time, last recessions, we actually had a dip in home prices. It dropped by about 20, 30, 40% at one point before climbing back up. But prior to that, all other recessions, we seem to be holding either a positive or a steady growth. So now if you ask me, let me go back to the previous slide. If you ask me about what's going to happen to sales and price, I'll tell you that I don't have the crystal ball, but I can tell you that chances are both sales and price are going to go decline this year in 2020. And very likely we will probably have a high single digit decline in sales. Just keep in mind, we could be losing 2 months of sales. 2 months of sales that may be at the home buying season, which is April, May, possibly a little bit of June. So we could be losing some sales in those 2-3 months. And afterwards, the economy is not going to be as strong as what we had before. So we're going to have some slowdown. So sales probably will slow down. Exactly by how much, I don't have a specific number, partly because I'm not very sure about, how long that recession is going to last. Um, as I mentioned, many economists have already made changes within a week, 2 weeks on their forecast. So I will tell you that most likely we'll have a high single digit decline in sales. As far as price is concerned, I think it will hold a little bit better. We're still going to experience a decline in price, most likely in the 5 or 6%. Now, the luxury home sales market could actually see a little bit of fluctuation, partly because of the concern about the stock market as well. Now, if the financial market actually started rising in the second half of the year, getting back to a little bit more normal, that might actually cancel out some of the negative impact that we experienced in the last last month or so. But that we'll have to wait and see. But safe to say, we will see a single-digit decline in sales and a single-digit decline in price. But the price decline will probably be a little bit less than the decline in sales. And I mentioned earlier about a slide that you should take a look at. This is a slide that you definitely should look at. This is where you will find a lot of resources for yourself on the coronavirus. We have a page, CR created a page called a Coronavirus Update Microsite. It provides very up-to-date information, the very industry-specific information about coronavirus outbreak. And it is at carcovidupdates.org. And if you click on there, if you go there, even if you go to the CR website, there will be a link that you can click on and lead you to it. This is a lot of information, and we try to update this on a regular basis, on a daily basis. And we also send out a weekly newsletter, usually sent out, I believe, on Thursday, to give you not only the housing market update, the 10 bullet points on housing market updates, but also some of the other information related to coronavirus. Now, if you want to talk to somebody about the particular programs that I mentioned that's offered by the CARES Act, the COVID Relief Hotline, a hotline that we recently launched yesterday, in fact, could provide some one-on-one assistance to our members to answer questions related to the financial assistance programs that's being offered by the fiscal stimulus. And the COVID Relief Hotline is 213-351-8450. And then the link is right there. The link on the CR website is right there. You can get a little bit more information on it. And then something that we released a little earlier, 2-3 weeks ago, was the coronavirus addendum and amendment form. That is another contract form that you may want to take a look at when you talk to your buyers and sellers, because this is a form that can, in case anything happens due to the coronavirus, so there will be some agreement on it. So take a look at it. I don't have the link here on that form, but you can certainly go to the CAR website and take a look at that form. Now, I'm going to give you a few seconds, maybe another 15-20 seconds to take a look at the slide, and maybe if you want to get some additional information, copy the relief hotline. And I believe the hotline is usually open from 8:30 to 5 o'clock. But there's a lot more information if you go to that link and take a look at it. Right now, I know that the hotline actually has been very, very busy since it's only has gone live for 2 days. But they do try to get as much information from the person who called and try to call back later if they could not get an answer to them right away. So definitely take a look at the microsite and definitely take a look at the relief hotline. All right. Then I promised I think in the promo that I'll go over a little bit about the international buyers. Let me go through a little bit about the international buyers, not a whole lot. So how would the current market conditions and the coronavirus impact the international buyers? I know many of you deal with international buyers on a very regular basis. In the last few years, we actually have already been seeing some decline in terms of members working with foreign buyers. If you take a look at the chart here, I think in 2015, this is a national number, by the way. In 2015, about 35% of members who responded to the survey worked with the foreign buyers. That actually has been declining. Recently, it dropped down to 20%. Now, this, of course, has nothing to do with coronavirus, but as home prices continue to rise, as other factors such as difficulty in getting cash out from China because of the cash outflow restrictions probably led to the decline in foreign buyers. Now, in California, we also saw that, we also have been seeing that international buyers actually dropped to 4%, close to 4% from 2013, it was 8%. That's also because of increase in home prices, but also domestic buyers from 2013 on has been improving as far as their financial stability, as far as their financial capability. So there are more domestic buyers buying home in the last few years, which push home prices up, also lead to fewer buyers, foreign buyers buying in California. And if you take a look at the actual numbers, this is compiled by NAR, you can see the top 5 countries where foreign buyers came from in 2019 all dropped compared to the previous year. Canada, China, India, Mexico, UK, all dropped in terms of their dollar volume of sales. And it is not just because of home prices, but also because of their number of transactions that they purchase. Again, it could be because of home prices. It could be because of other reasons, political reasons. Could be another reason. Again, going back to California, used to be in 2016, 53% of home buyers were from China. Foreign buyers were from China. It dropped to 33%. So even before coronavirus, we started seeing a drop off in share of Chinese buyers or share of foreign buyers actually buying in California. But the coronavirus probably will keep the number of sales down from foreign buyers, partly because many of those countries are also hurt, by coronavirus. China had their coronavirus pandemic. They had a lockdown. Their economy, I think it was originally predicted to increase economically by 6%, close to 6% for 2020. I think it got adjusted down to maybe about 3%. Other areas like other countries like UK and Canada also have adjusted their economic forecast. UK currently has been affected by coronavirus by a lot, the coronavirus pandemic by a lot. Italy, obviously. So as far as EU, as far as Asia is concerned, I think some of the foreign buyers probably will not come back until maybe the second half of the year, or maybe the fourth quarter or so. But at the same time, we also have the restrictions, travel ban restrictions that the U.S. imposed on some of the other countries. So it's going to take a while for all those to clear up. So it's safe to say, as far as foreign buying is concerned and international buying is concerned, probably will slow down until at least, up to later this year, like maybe August or so. So it's going to take some time, and we just have to get through this challenging time in the moment. Hopefully things will pass very, very soon. And I do believe that once we get through it in the late third quarter and fourth quarter, well, we'll be able to come back and continue to recover in 2021. With that said, that is the end of my presentation. Thank you again for inviting me. And if we have time, we can go through some of the questions that people ask, if there are any questions.
Okay, thank you, Oscar.
You're welcome. You're welcome.
We do have a couple questions. I'm going
Sure.
to share our sponsor screen here. Give me one moment. There we go. That works. Okay. So one question was, can you comment on many banks are pulling back on higher loan to value loans? Also, there are talks from Fannie and Freddie may have a price markup for higher loan to value as well. How will that impact the first-time home buyer whom whom only have 5 to 10% down?
Now, I think I've heard, things anecdotally, and will tell your friend that I would probably need to take a look at it a little bit more further on lenders on some of those loans that actually require a smaller percentage of down payment. For example, I think FHA loans, for example, I've heard anecdotally that there might be some lenders that may not necessarily want to approve FHA loans for now. So now, as far as first-time buyers is concerned, some of those lenders, the current market conditions, the mortgage environment right now, it's true. Some of the first-time buyers probably will get hurt. In the past, we have first-time buyers as we have the share of first-time buyer as a share of total home sales is usually about 32-33%. I think last year was 32-33%. That number probably will go down, partly because many of the for many different reasons. First, I showed you earlier the reasons why people are backing out. Buyers are very, very concerned because of their economic conditions, because of their financial concern, uncertainty about the financial ability. Same thing for mortgage brokers and lenders who lend money to them. They're concerned about whether many people who maybe, let's say, what happened to the financial market in the last couple months or so, what happened to the labor market in the last couple months or so. Many of those lenders could be concerned about, whether first-time buyers or people who have low income will be able to qualify to buy a home. So it is very possible that in the next couple months or so, we may actually see some tightening in funding in funding to first-time buyers. But I think this will also pass. This is an unusual time right now in the next few weeks or so. Once we get to, let's say, May or June, we probably will have a little bit more liquidity. Remember what I said earlier about the Federal Reserve trying to establish new programs, trying to establish a market liquidity. They're trying to make sure that lenders are able to continue to loan to whether it be people who are asking for small business loans or whether it be homeowners who are trying to buy their first house. So this right now, I think in the next few weeks or so, it's going to be tough. It's going to be tight. But once we get through the next few weeks or so, once people realize the Federal Reserve actually is making, lending a little easier, then things might actually go back to a little bit more normal. Now, when I say a little bit more normal, we are still going to see unemployment rate going up, and many people are going to lose their job, and so it's definitely going to. I think it's probably going to hurt first-time buyers a little bit more at the beginning, as compared to repeat buyers. So I assume first-time buyers will probably take a little bit more hit in the next few weeks, next few months or so, and we may. The thing is that I want to comment also is usually I want to say at a seasonal level, first-time buyers typically don't necessarily buy during the April, May, and June. Those months are usually home sales usually took place during home sales that took place during those months usually are for people who have a family, want to move during that period of time when their kids are actually in summer, during summer. So first-time buyers may actually have a little bit more time to adjust, and they actually might start coming back more towards the end of the year. maybe in August, September or so, start looking for homes when things get actually a little bit better, when the economic conditions kind of stabilize a little bit. So hopefully I answered answer your question.
Thanks, Oscar. We have another question. Do you see any impacts on new homes? Do you see any impacts on new homes that are being built?
Definitely, there is some impact. Now, I haven't read the latest specifics. There are quite a few layers on new homes being built, new constructions. For one thing, there have been some confidence on builders probably have been affected. They realize, many of the builders probably realize, okay, well, the economy is actually slowing down. It looks like the housing market is slowing down. People are not buying a new home. So there will be more homes available on the market in the second half of the year because, it's basically came to a stop, and it probably will be stopped. The housing market probably will be stopped for the next weeks, months coming until maybe somewhere in June. So as far as new construction is concerned, I think they're putting some builders and developers are probably putting things on hold. But at the same time, we also started seeing something that actually happened, not necessarily because of the coronavirus, but the issues with trade that we experienced at the end of last year, things that kind of relieved a little bit this year at the beginning of the year. Because of the trade restrictions that we had in 2018, some of the construction material prices actually got up, got increased a little bit at the beginning of the year. Now, with the coronavirus, with the economy actually slowing down a little bit, whether the prices on those material actually has come down, it's hard to say for sure. But you can bet on the fact that construction, probably many of the developers and construction companies are probably being put on hold for now, and so we may not necessarily see a lot of things being built. Plus, there are not a lot of people being able to work during this period of time because they may not necessarily be considered essential service. So there might not be a lot of homes being built during this period of time. So that's delayed the new constructions for the next few weeks, maybe even for the second half of the year, depending on when we're going to have the situation being under control.
Oscar, we got a question coming in here from Nicole Canyon. From the global standpoint, we've seen more outgoing referrals in business to other countries in recent years because the value in the dollar has been very high, and for foreign buyers, it's been very attractive to asset in other countries that would yield bigger returns, especially in developing and redeveloping economies. So seeing this and knowing this, it kind of piggybacks off of a question I have. Do you foresee property values dipping to a level that might scare off buyers right now and have them just be patient until trying to purchase in the future?
Well, as I mentioned, I think we are going to see some decline in home prices. Now, it's not going to be. I can tell you that we're not going to see what happened in 2008, 2009. Remember, in 2008, 2009, home prices went all the way up to close to 600,000 for the statewide median price, and then it dropped back down to close to 300,000. So it dropped by 50%. This time around, we probably won't see home prices got up to go down that deeper level. We probably will see home prices go down to maybe about, as I mentioned, single digit. I don't even think it will go down to double digit, probably just single digits, and it's probably going to be 6 or 7%. And the reason why we're going to see home prices not dropping as much as before is partly because of the interest rate environment as well. Remember, go back in 2008, 2009, even when we were in a recession, I think interest rate at that point was somewhere around 5.5%, 6% or so. It actually may have gone down to 5.25 or so. But look at what we have right now. Right now, we have At some point last week, it might have shot up to 4, but then it came down to, I think currently the Freddie Mac's number is probably average is about 3.5 for the 30-year fixed rate. And the next few months or so, the number probably will fluctuate at around 3.5, maybe even go down to 3.5 to 3.3 or so, because the Federal Reserve has already moved the interest rate, the Fed funds rate down to 0, and then they're doing all those quantitative easing and things like that. So I think for the rest of the year and probably in 2021, we probably will see interest rate remain at a low level, like 3.5 or below. That actually helps, the lending cost for borrowing costs for buyers. So it helps buyers to come back, and it will give some support to sales as well. Last time, remember, as I mentioned, home prices was all the way up to 600,000 in 2008, and this time before the coronavirus actually got hit our economy, the median price at the state level is around 600 and 605. So you can see the median price at the state level comparing 2019 or 2020, beginning of 2020 to 2008 really didn't change that much, or 2007 really didn't change that much over the last 10, 15, 10 years, 11 years or so. So I do believe that this time we will have a little bit of decline in price, but probably not as much as before. And probably it will pick back up in 2000, and it may not pick up in 2020 at the end of 2020, but in 2021 we probably will start seeing a little bit of growth in price compared to 2018 price at the very beginning, if we actually have the economy going back to normal.
Great.
And just to
Go ahead.
follow up as well, do you see any increase in NODs for notice of defaults or foreclosures starting to pick up in the state of California?
I have a feeling that in situation like this, and when the economy is actually close to collapsing, at least for a few weeks or so before picking back up, there are always people who may not be able to afford their home, may have to file foreclosures, but the Federal Reserve and also the state government, the state of California, did put a moratorium on foreclosures. So this time around, I think we probably will see, people homes being foreclosed. There will be some NODs, but we're not going to see what we saw back in 2008, 2007, when people over leveraged. I think this time we have more responsible home buyers who purchased a couple years ago or last year. They were probably a little bit more responsible.
Okay. Let's see, we have enough time for 1 or 2 more questions. Can you recommend some articles for buyers or borrowers to ease some of their concern about the housing market? Is there anything on CAR website?
We definitely have a lot of information on the CAR website. The link that I showed you earlier, the covert, CAR covert, I can't remember the exact name. There is a website, a microsite on the CAR website that link you to the COVID-19 updates. And on that website, we have, on a weekly basis, we post housing market update. In that housing market update, we have 10 bullet points every single week that shows you, tells you a little bit about, what the market condition is right now, whether buyers and sellers, what buyers and sellers should know. And so you can take a look at that. And we also believe we just posted a housing perspective. This is what we used to call a market outlook or market update. That housing perspective is a one-pager that members can use and put their name at the. You log into the CR website and log into the housing perspective. It will auto-populate your name at the very bottom, so that you can use that one pager and send out to your client. And that one pager this time, that housing perspective piece that we just put together, it is about coronavirus. So take a look at it and see if it is useful.
Okay, one last question.
Sure.
Does future outlook include the second wave of the virus outbreak that many are predicting in the fall before a vaccine is available?
Yeah, that's a very, very good question. Now, the model that I showed you earlier, that's one model that I showed you earlier. It only show the when the outbreak is going to peak, and then it's going to kind of slow down a little bit. There could possibly be a second wave, yes. And if there is a second wave, hopefully people are a little bit more prepared. And I think I've heard from other medical experts about the possible second wave and how it could hit the economy. And if that's the case, yes, it's going to have an impact on the economy. Certainly, I would say many of the economists many of the forecasts that those economists predicted in the chart that I showed you earlier may not have predicted a second wave. Um, so if we do have a second wave, I think the recovery period will probably, the fourth quarter that everyone is showing a positive, probably will have to be reduced. Um, if we do have a second wave, and hopefully, and if that second wave is also of considerable magnitude, then of course we might go on in 2021 with a slow economic growth or even no economic growth. But hopefully we learn our lesson and we'll be able to contain. And even if we have a second wave, there will be only a minor blip, but not a more significant blip in terms of